Hey everyone, thanks again. Welcome back to the Final Bar. This is Dave Keller from StockCharts.com. I want to welcome on my guest today, Jesse Felder from the Felder Report. Jesse, welcome on. And listen, this is our first show in a new series, and thank you so much for agreeing to be my first guest. I really, really appreciate it.
Hey, I'm absolutely honored, and congrats on the new show. This should be fun.
Thank you. No, it's a lot of good stuff to do. And again, I've followed your work for a while. You've always been very generous on social media and with a lot of people sharing thoughts. So excited to hear what you have to say. You sent us a couple charts ahead of time. We're looking at a chart of the 10-year yield to start out with. What are you seeing overall?
Yeah, basically we've had this huge rally in bonds, this year, and it's driven by, falling interest rates. So this is a long-term chart of the 10-year yield. And you can see basically that indicator at the top is basically just the 12-month rate of change. We've seen the 10-year yield fall at about a 50%, or make about a 50% decline over the last 12 months. And that's really only happened two other times in the last 50 years. And there's been plenty of times when interest rates have dropped dramatically, but usually when you see rates drop this quickly over this period of time, they bounce back pretty quickly too. And we saw that in late 2008, we saw it in late 2011, early 2012. And so I think we're probably seeing a bottom in yields here too, just because the move has been so swift. But there's a couple other charts, that I sent too, just messages from the commodities markets that are also suggesting that we could see rates back up again. And they started to do earlier, kind of in the middle of this month. This is a chart that compares the 30-year Treasury yield to the oil price. And you can see usually these move in the same direction, that interest rates move up as oil prices move up and vice versa. In 2016, we saw yields plunge, to those lows that were just taken out, by the 30-year yield. And the oil price diverged pretty dramatically in that summer of 2016, kind of really suggesting that the move, that the drop in interest rates was probably overdone. We've seen that same kind of thing over this summer and into the fall, where we saw yields drop dramatically, but oil prices have still been kind of powering higher, at least sideways, if they haven't plunged. And so to me, that's one kind of red flag that we're commodities market is saying this drop in interest rates is probably overdone. But the final chart that I sent over shows the 10-year Treasury yield compared to the copper to gold ratio, and these are very highly correlated. And so, to take a look at what's going on in the copper and gold, I like to look at pretty regularly the futures positions in the futures markets. We saw last week gold hedgers, considered the smart money. Commercials are essentially selling forward more gold than they ever have in history. So they have their largest net short position in gold in history, while you have copper hedgers, almost the exact opposite situation. They're just off of their highest net long position in history. So to me, this tells me the smart money between, the copper and the gold hedgers are betting on this ratio moving significantly higher, at least copper prices being much stronger than gold prices going forward from here, which would be very supportive of higher interest rates. So all these things kind of together suggest to me that interest rates have hit an important low here and are due to rally.
These are just three fantastic charts, Jesse. Thanks so much, and thanks for talking through them. It strikes me as I'm looking at them how long-term they all are, and there's a lesson just on that. And I'm back on your first chart, looking at a monthly chart of the 10-year with the 12-month rate of change. And in my office, I used to have just a 10-year rate of change on the S&P 500, and I always said if I only had one chart in terms of like thinking of long-term secular cycles, like that's all you needed, because it just told you the overall trend. So this is such a great illustration of sort of the relative weakness of where we're at in yields relative to that historical trend. So my question to you, how do you compare this? How do you take this long-term monthly chart of the 10-year and then marry that with what you're seeing day to day? Because I think a lot of people obviously get really caught up in the short-term movements in bonds and stocks and others. How do you relate that to what you're seeing on the long-term chart? How do you balance those two?
Yeah, I mean, it's such a great question. I'm really glad you asked it, because whenever I find myself looking at daily charts too much, right? There's so much noise, and it's so hard to kind of come up with a view or an opinion on that time frame. So I always, whenever I'm kind of questioning, wait, what the heck is really going on here? I zoom out, and I think weekly charts are probably what I look at the most. But
Right.
I think it's nice to look at the monthly charts, and I really like the feature that StockCharts has. It allows me to look at quarterly charts because I think those can be valuable in their own right, and I haven't seen that on a lot of other platforms. So. Yeah, I really kind of like to take a long-term look, and I think it helps to understand the direction of the primary trend and kind of use that filter when you're looking at the short-term stuff. And so I guess what I'm talking about here is a longer-term potential trend shift, and so when I start looking at these longer-term dynamics, it really helps to inform that short-term view.
That's fantastic. Jesse Felder, thanks so much for coming on today. Ladies and gentlemen, I want to thank Jesse for joining us today. What a great lesson. And if you took nothing else away from his comments, although his take on bonds, on copper gold ratio, that's fantastic. I'd remind you the lesson of incorporating some of the longer term views into what you're doing. There's a lot to unpack there. Thanks again, Jesse.
Hey, thanks, David, and good luck with the new show.